this is shocking. This is shocking, and the market is sniffing out that something is wrong. All right, everybody. Welcome back. Today is Thursday, February the 19th, and we had some really big news today that is the latest in this saga that we have been talking about here at Reveille for quite a while, and that is this storyline around the AI data center build out and potentially implosion that has been going on. So that has been a big topic of discussion for us really since September of last year. And so I'm going to share what this big story development is today here momentarily, but I just want to set the scene that this big build out of data centers and AI that has happened over the last 18 to 24 months in this country, it has largely been financed by non-bank lending, non-traditional lending. It's not money that is coming from a bank, from a commercial bank, like a Bank of America, a Wells Fargo, a JP Morgan. They're not the ones that are extending the credit facilities for these places to get built. No, it's being funded by pools of investors that are in what we call private credit pools, where their money is being aggregated, and then that pool is loaning the money out to developers to construct these data centers. And so the build out, it has certainly come with a lot of hype, a lot of fanfare. AI is going to change the world. But the problem is that it runs the risk of being overbuilt. And perhaps it is already overbuilt because we don't necessarily have the energy resources necessary to have all these things come online. And if we do find ourselves overbuilt, then it's going to leave the people that have financed these projects, they're going to be the ones holding the bag. And so people that did not necessarily intend to place their money at risk are going to be faced with potential material losses. So Blue Owl is one of these companies that aggregates a lot of this investor capital to deploy. And so we've talked about how Blue Owl was one of these companies that we believe was at the tip of the spear of this potential AI implosion. And so we can see here, so Blue Owl, they operate as an alternative asset management firm. They provide investors access to asset management capital solutions through its direct lending and their general partner capital solutions products. And so they offer a platform of capital solutions to both middle market companies and large alternative asset managers. So what that really means is they're one of these companies that rakes in billions of dollars from investors, and then they will go and lend directly to particular projects. Now, it's been very vogue to do the lending into the AI in the data center space because it sounds very sexy, and they also talk about how it's securitized and it's going to be deemed safe. Now, the issue with these types of strategies, right? Because what they're promising to investors that are participating in these pools is not only are you going to be a lender against this real estate in this development, but you're going to receive X amount in terms of your rate of return, and it's not going to be correlated with what happens in the stock market or even the bond market. And so after what happened back in 2022 when interest rates started going up and it was a really rough time for conventional fixed income, a lot of investors were saying, I want something that it doesn't necessarily have the interest rate risk that traditional bonds do. And so these large wealth management firms were all too happy to say, I've got this private opportunity, this exclusive opportunity for you um, to invest in these kind of business development types of products where you're going to be lending into the AI build out, into the data center space. Now, the issue with these alternative investments, unlike conventional investment products, stocks or bonds that you could buy or sell on the market any day of the week, is that these are not daily liquid. You're only going to be able to get your money out at some predetermined intervals, and they also don't value it on a daily basis. There isn't a market for this where somebody out there was buying the same shares of stock that you were, and so you know what the price is if you choose to sell it. No, these private credit vehicles are things that are audited maybe once a quarter by a large firm out there, the KPMGs of the world, the Ernst and Youngs of the world. They will go out and audit these projects, and they will assess what they believe is the value of those underlying debt holdings. And so that's what would be reflected to the investor on their quarterly statement. Well, the problem is, uh, I do not believe that the marks that have been placed on a lot of these investments are actually really good reflections of how these strategies have actually been performing. And these private credit markets are the potential powder keg for this economy to go south. And that has been the topic of conversation amongst these updates that we've done, where we've been asking, are we in the biggest bubble of our lifetime? And we talked about Blue Owl last time. And if this was a bubble that was starting to unravel, that there would be signs and there would be markers. And so we've documented these along the way, that if that was going to happen, some of the first things that we would see is that projects would be delayed. Check. We've seen that. We've seen some of these companies participating in these AI build-outs that would renege. That would be the next sign. Check. We saw that where Blue Owl was supposed to fund a data center in the state of Michigan to the tune of $10 billion. They backed out of that late in 2025. And so the next thing that we would see that would let us know that there was a real problem was if all of a sudden these private credit funds, if the investors started to know that something is awry, but the funds would say, you can't get your money out. That's what happened today. That's the big news today, that Blue Owl has decided that they are halting redemptions on this one private credit fund. There's $1.4 billion in this fund. Now, the issue is that there's never just one cockroach. And this feels very reminiscent of what we saw pre-financial crisis, where there had been a lot of investing into mortgage-backed securities because they were securitized, they were deemed safe. And then all of a sudden, we find out that the quality of these underlying mortgage bonds is not good. Maybe there hasn't been a lot of due diligence about the borrowers. And we're finding out today in 2026 that is more of a common theme today than we would like to admit. It wouldn't happen in the banks anymore because the banks have regulations that they're going to be held to. They can't do that. But these alternative investments, these private credit funds that have money coming in the door, and they are obligated to take their investor money and go and put it to work by prospectus, a lot of times, unfortunately, I don't think they can be overly discerning about where the money goes because they just have to get it put to work. And the concern that we have is that these underlying investments are not performing. We covered this in our monthly update in January, that Apollo, which is another large firm that engages in a lot of this similar type of business, although they may be a little more diversified, that they took a 34% hit. They had a $500 million investment that they had made, and they recorded a $170 million loss on that, a securitized investment that was deemed safe, took a 34% loss, and they got out. You've got a lot of well-intentioned retail investors that have been sold these private credit funds trying to escape interest rate risk. And, oh, you're going to be supporting the build out of all of these data centers. But these folks, I believe, are not attuned to the fact that they may potentially get back a lot less of their principal sometime in the future whenever they are able to get it back. Because right now, this fund is telling them you can't get that money back at all until we say so. The writing has kind of been on the wall, right? Where we've talked about how the actual value of those funds, the performance of those funds, since they don't value them on a daily basis, they're not publicly traded, that the marks that are assigned are maybe not a great reflection of how those strategies are actually performing. And we said, I think maybe the stock of Blue Owl may be a little better indication of how they're performing. Well, yikes. This thing has gone in the last year from almost $27 a share. Today it closed at $11.58. That's a stunning decline. Absolutely stunning decline. They're not the only ones, right? You have companies like Blackstone that are also in the space. Their stock was down over 5% today, right? It couldn't hold on to a former high back here around $150. This doesn't look great. KKR, right? A little bit of a similar story, right? Again, this one's maybe a little larger, a private equity firm that is more diversified. It still is not immune, right? Was down almost 2% today. It would really need to hold this level. But look at what it's done, right? Since the same time period last year, it's gone from 164 down to 101, where it closed today. This is shocking. This is shocking, and the market is sniffing out that something is wrong. Something is wrong. It's in this non-traditional lending space that before the financial crisis, it was in the banks, and this what almost took the banks down. Now it's in the private credit markets, and you have investors that have taken some of their money that would likely otherwise be invested in bonds, and they have put it into these private credit facilities. And I fear that things are going to go quite poorly for them from here. All the markers that we had talked about being concerned about just in the last 5 months, we've seen it. We've seen the delay of projects, reneging from projects. Now we're telling the investors who are financing these projects, you're locked up. You got to stay in. You cannot take your money out. That's not what you want to see in this story. If you're bullish, if everything was hunky-dory, you wouldn't have to tell people you got to stay in. We're closing the gate. They would want to stay in, but that's not the case. And so this is just the next leg of this saga. I'm going to be very interested to see how it unfolds. But the more of these stories that we see, that's not a good sign. And there's never one cockroach. So I want you to be careful out there. Make sure you're managing your risk. If you're invested in those types of funds, I'm sorry, but you're not going to be able to access the capital that you put in there likely for some time. And I hope for you that you're going to be able to get back the money that you put in there. I fear that that's not the case. So we do not like to engage in those types of investment styles because we want to be able to enter and exit an investment at our discretion. And when you get into these private strategies, these alternative investments, the timetable is not yours anymore. And some people are finding that out the hard way today. So, all right, that's the update. We want to bring you, we'll continue to bring you the latest in how this story unfolds. So stay tuned. Make sure that you are subscribed to our Reveille Wealth Management YouTube channel. Hit the notification button. And that way, whenever we bring on the next update, you're going to get a notification, and that information is going to be there for you. So thanks for tuning in. We'll look forward to catching up with you next time.